Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. You know, domestic fixed income has been a hot topic recently, and rightfully so. You know, after years and years of low yields, savers have finally been able to celebrate as yields have climbed, um, to average or have normalized really since the great financial crisis. Well, I had the perfect guest on today to talk about fixed income landscape and some of the lesser known and lesser talked about areas of the fixed income space. But first, today's episode is sponsored by the award-winning Zephyr, which helps financial professionals make more informed investment decisions. I'd like to give a very warm welcome to Fran Rodilosso. Fran is the head of fixed income ETF management at VanEck. Fran, thank you so much for coming on the show. It's really such an honor to have you on. I can't thank you enough. Can you please tell us a little bit more about yourself and VanEck?
Sure. Maybe I'll start with VanEck. VanEck is a global asset manager, more than $100 billion recently in AUM on a global basis, most of that in the US. VanEck has been around for almost 70 years and was originally, involved more in international mutual funds, and then is very well known for gold investing. Today, the vast majority of assets at VanEck are in the form of exchange-traded funds or ETFs in both the equity and fixed income space. And as for me, I manage the fixed income ETF portfolio management team. I've been in that role for the last 12 years, been in fixed income for about 30 years, maybe a little longer. I've been a sell-side trader, an active manager, and a passive manager in the fixed income space. I spent a lot of my career focused on emerging markets, about the first 15 years or so, but have been broadly involved in a number of asset classes for the last 14 or 15 years.
Fantastic, Fran. Thank you so much. So you've seen a lot in those 30 years. I love it. It's interesting how, PSN, part of our product offerings, our separately managed account database, has been around for 40 years. So I'm writing some articles looking back at 40 years, and it's amazing what we've seen in 40 years, especially in the fixed income space.
Yeah, we love to look at histories. And you mentioned, first of all, I agree with you completely. The backup in yields, which was painful from a mark-to-market perspective, is something to celebrate in a way, because we have had a normalization. And when we look back at histories especially for quote unquote risk-free yields, I think you need to ignore sort of 2009 to 2021. It just is not something any of us hope we see again, nor even from a policy perspective, do we think we'll see again. So looking back at the 90s, 80s, 70s could all be pretty instructive in terms of where we might be headed for various asset classes.
Yeah, and it's interesting. You're exactly right. Well, I said celebrated higher yields. It was very painful. 2022 was a very painful year for fixed income investors. But when you think about it, it was kind of needed, right? To allow savers actually, so they don't have to get more risk or take on more risk to get 4% yield.
Absolutely. And it also enables even, called institutional investors, the most sophisticated investors, to properly price risk. So I think for everybody, this has been, in a lot of ways, a very, very good thing. But as you say, most importantly, savers.
Yep. Awesome, Fran. So let's start with emerging market debt. The VanEck Emerging Market Fixed Income team recently put out an article titled Golden Age for Emerging Market Bonds. And you recently wrote an article titled Technical and Fundamental Factors Paint a Rosy Picture for Emerging Market Debt. Can you add a little bit more color to why VanEck team and yourself you think that emerging market debt offers such a great opportunity for investors?
Certainly. So just to lay the landscape a little bit, the team that put out the Golden Age piece are our active EM debt management team.
Okay.
And then my team manages some passively managed ETFs in the emerging market fixed income space. They're a great team, extremely thoughtful, go anywhere in EM, hard currency, local currency, sovereign and corporate. So, and they do a lot of on the ground work. They travel constantly, have economists, traders, former economists, or as they like to say, reformed economists. The point we all agree on across the teams and really elsewhere in the firm is that EM is in a different phase right now relative to developed markets. In so many ways, the tables have been turned. So when you look at simple statistics like sovereign or government debt to GDP,
Yeah.
your largest developed markets, including the US, now look like those scary emerging markets from several decades ago. Meanwhile, emerging markets on average have debt to GDPs that are somewhere in the area of 1/2 of what we're seeing in developed markets.
Wow.
That's the stock of debt. From a flow perspective, they're taking on debt at a slower pace. They have better fiscal balances on average. And of course, the big concern, or I guess the big point, is emerging markets pay more than developed markets. And so, and for a lot of reasons, there are assorted risks in the emerging market debt space. If you're talking local currency, of course, there's FX risk. If you're talking dollar debt, you're still concerned about governance and rule of law and political issues. But what has happened over time is emerging market central banks and emerging market governments have actually been, we'll call it, they didn't go into that abnormal period. They've been more restrictive, more conservative, and they haven't yet been fully rewarded. And that's the point. The piece Bill Sokol and I put out at VanEck was the last several years, you've seen mostly outflows from emerging market debt. Even as the technicals improve, the relative fundamentals improve versus developed markets, and they outperformed. So when there's a risk-off tendency in the market and off rate moves, people were selling a lot of different types of fixed income. Sometimes emerging markets is the first thing that goes. So we think it just created a really good opportunity from a timing perspective and a fundamental perspective, because EM does not read as overbought, and the fundamentals are still looking better. And to overgeneralize, you're earning higher yields, even where the fundamentals are very similar.
Mhm. That's awesome, Fran. You mentioned emerging market local currency bonds, right? And there's some risks there with currency risk and so on. But local currency emerging market debt outperformed many US fixed income sectors in 2023. What drove that performance? And do you see that continuing?
So what drove the performance was really had to do with the fact that emerging market central banks were more aggressive than the developed market central banks, especially the Fed, well, actually versus all of them, in terms of hiking early and aggressively. And so what you saw by the time we got to the big rate sell-offs in 2022, and then continued for the first 3 quarters, at least, of 2023, most of the emerging market local currency markets had already been there. Their central banks had, and not only that, you saw inflation turn downward in those markets sooner than you saw in developed markets. So even if inflation had hit higher levels, you had higher real rates in emerging markets, which means the rate your government debt is paying or policy rates are above inflation. That just enabled there to be some gains in terms of rates coming back down as inflation fell. Some emerging market central banks have already begun to start easing because they've been able to. And then the carry was higher because the yields were high. And this is the great thing about, again, being in a normal interest rate environment, that carry is the most important component of return historically. And it can be, once again, you don't need just capital gains to earn on your fixed income investments. And so emerging markets had better carry. Interesting side note, the foreign exchange return component of EM local currency debt throughout that period was negative. You don't need to make the FX gains in order to outperform, but you do need some type of FX stability. So year to date this year, emerging market local currency debt is doing better than, say, long-term treasuries, than say,
Yeah.
the 10-year and beyond. But it's also down on the year because of the dollar strength we've seen through the first 4 months of the year.
Interesting. Great information. Emerging market debt, I always feel like you said, there is a good opportunity there. They pay more, higher yielding. If you take on that risk, it's a good way of getting more yield in an investment portfolio. Let's pivot here a little bit and talk maybe a little about some less traditional areas. And one area in particular where you're finding attractive opportunities, which aren't typically covered in aggregate type strategies, is CLOs, or collateralized loan obligations. What has been the catalyst in these strong risk adjusted returns that CLOs have had versus other areas of fixed income?
Yeah, CLOs. Thanks, Ryan. It's a really interesting topic.
Sure.
They've been around for more than 30 years, and as you said, collateralized loan obligations. They're just pools of large cap bank loans or leveraged loans that are securitized. So the securitizations are done in tranche form, like many other securitizations, which means there's a waterfall of cash flows.
Yep.
There's an equity tranche that takes first losses, and then mezzanine tranches that take the next losses, all the way up to AAA. CLOs are quite different from a lot of other securitized products in a couple of ways. And I'll start with one, just looking backwards at performance. Yes, they've been one of the best areas to be in fixed income the last several years, but what about stress periods? The global financial crisis, CLOs were in existence. The structures held up extremely well. There were very, very few defaults on any CLO tranches, and no defaults on the AAA tranches, which is over 60% of the capital structure. So some unique characteristics. One, a CLO, the pool of loans that's underlying the securitized structure, is analyzable. Usually there's about 200 to 400 loans in a collateralized loan obligation.
Okay.
Someone investing in CLOs is able to have much greater transparency into the underlying assets versus someone, say, buying a pool of some subprime mortgages or some global CDO that has all sorts of derivative structures included in it. And those are the types of structures that didn't do well in the global financial crisis. What you're getting in CLOs is a way of, let's call it, enhancing the credit quality of it's like a yield enhanced exposure to the levered loan universe. And that yield enhancement comes through the securitization, through the subordination of lower rated tranches and equity. Yet they still pay a higher yield. If you look at AAA CLO tranches, they yield about 150 basis points over SOFR right now. It's as good or slightly better than BBB rated in corporate bonds. So you're getting a yield advantage, a high level of credit protection, and they are floating rate, which of course helped the performance while rates were rising the last several years.
Interest. And a lot of people think, rates are going to be higher for longer, so that probably benefits CLOs there too. So we mentioned that CLOs aren't typically part of the aggregate type strategies, like those bigger, index following, the Bloomberg egg. How would you gain access to this? Would it be more of a specific thematic ETF that focuses on CLOs?
Yeah, great question. So what's interesting is, for the first few decades of CLO's existence, or 2.5 decades, when they weren't really available for retail investors or for advisor allocation strategies, there was a tremendous amount of institutional involvement. So in other words, insurance companies
Mhm.
have used CLOs from the beginning, and it's a big part of their fixed income asset allocation. Why? Because they've actually had the best Sharpe ratios of any bond or fixed income asset class over multiple different periods, and so risk adjusted returns. you can reduce duration, add yield, uh, and so that, that's advantageous for a lot of people. What the game changer was when the ETF rule changed back at the end of 2019. There were some new allowances for different types of structured credit inside the ETF structure.
Okay.
And so now investors are able to access different varieties of CLOs, meaning all AAA, broad investment grade, down to the more mezzanine triple B, double B. So there's a menu of exchange traded funds to choose from to directly access collateralized loan obligations.
Fantastic. That's great information. I've over the years, that's like separately managed accounts and other alternatives, 10, 15 years ago, it just, they weren't accessible to the retail investor. So it's always great to see this innovation and evolution of this space where retail investors can now get access to such great investment products that help the investment portfolio.
Yeah, it is great. For VanEck, by the way, since we did not have a full uh, experienced credit team, we partnered with an experienced manager in the
Okay.
space, PineBridge. They're a sub-advisor on our ETF. They do separately managed accounts, but the minimums are very, very high. So, which makes sense just given the way the asset class trades. So this is, our ETF happens to be a great way for retail investors to access an institutional manager in the space with great experience. So, it's just the growth of ETFs and some of the rule changes have really, I think, been a benefit for retail investors.
Fantastic. Let's look at another non-traditional area. Private credit. We've heard about it for a couple of years now. Private credit continues to surge. They offer very attractive yields and diversification benefits when you include them in a portfolio. However, illiquidity presents a challenge. So how can business development companies or BDCs provide an alternative to investing in your traditional private credit strategies?
Again, I think for a lot of professionally managed private credit strategies, uh, many are not publicly traded, right? So they're difficult to access for a lot of investor types. Uh, and even some BDCs, there are several different versions of business development companies out there. They're
Okay.
publicly traded, they're non-publicly traded, but offered to the public in different forms, and then they're just private business development companies. But the publicly traded ones, they trade on exchange, follow the same rules as all other forms of BDCs. They're
Okay.
managed by some of the best credit firms out there in the private debt space. So it's a way for all investors to be able to access the private credit market. And business development companies operate under a whole bunch of restrictions. One is they have to pay out roughly 90+% of taxable income to make a long story short. So the yield on these equities is typically quite high because most of the income is being passed through to investors in a tax efficient manner because they're registered investment companies. So you're seeing for most BDCs today, the publicly traded ones dividend yields over 10% annually, for instance. But business development companies, they do use leverage, but they're capped by statute at 2x debt to equity. Most of the BDC managers don't fully use that leverage. You could think of it this way also, they're a lot less levered than your typical bank or, other ways of capital moving from from retail investors, say, to private borrowers. The BDCs have diversification mandates, and again, like other types of loans, about 85% of the portfolios in business development companies are floating rate in terms of the exposure. So you do have underlying floating rate exposure as well, so less sensitivity to rates. Obviously, high sensitivity to economic movements and credit. But it's another diversifier, another great carry story at the moment.
Okay. Fantastic. So my attention has been peaked throughout this whole conversation, but when you said over 10% yield, I was like, whoa. what obviously there's no free lunches in this industry. Where are the risks? Is it credit
Yeah.
risk, interest rate risk, like you said? If rates come down since it's floating rate,
Yeah.
where's your risks at there?
Yeah. So, talking about a couple of things we've been discussing. If you looked at AAA CLOs, you're not getting 10% yields, right? But you're getting, in the mid to high sixes with very, very low price volatility. For triple B rated CLOs, you can be getting in the low mid teens and getting a lot of volatility with that.
Yeah.
Same goes for business development companies. I mean, they're equities. They trade, as equities, as moderately leveraged structures as well. The sensitivity is going to be there to shifts in spreads in the credit space. Not so much shifts in rates, certainly not upward moves in rates because you're insulated. But in a recessionary period where there are concerns about credit, throughout the economy, these loans that business development companies make are to more the middle market. So there's
Okay.
a lot of non-publicly traded companies. Some are publicly traded, but they're generally below investment grade loans. So you have the underlying risk there. That's mitigated by the analysis, the strong teams that the business development companies themselves have, and it's mitigated by diversification, but it's still there. And so a lot of the risk can simply be reflected in the volatility of the price of the BDC equity that you own.
Fantastic. Thank you so much, Fran, for that, because that especially the BDC space, I don't think it's probably talked enough about. And there's not a ton of information about it, so it's very interesting. Let's focus back on the US, where bonds started to perform well into late 2023, and because of that had resulted in a solid return for 2023. High yield bonds have had a very strong past 12 months. So in that corporate bond space, where are you seeing opportunities from investment grade to high yield? Are there areas where you see most attractive upside, both in short term and long term?
We think you're in a period now where and you see this reflected in the market. Someone else said this the other day. I read it in a research report. There are buyers of yield and sellers of spread, which simply means credit spreads in both the investment grade and high yield space at this point in time look historically low. Of course, corporate fundamentals in both spaces in aggregate are exceptionally strong from an historical perspective as well. As much as we're all concerned about the US government balance sheet, the private sector, especially issuers of corporate bonds, balance sheets look quite good. Last quarter, we're seeing, starting to see earnings reports for this quarter. So you see things like net leverage ratios, not at all-time lows, but certainly near the very low end of the long-term historical perspective, the interest coverage ratios. Companies have been able to keep refinancing, pushing maturity walls out, reducing downgraded default risk. All these good fundamentals. However, should we enter a recession over the next 12 to 18 months, spreads don't reflect a whole lot of say they reflect relatively low odds of that happening. So there probably would be a correction, and that's kept some people away from especially riskier credit like high yield. On the other hand, broad high yield yielding over 8%, we happen to think that's fairly compelling in and of itself, given the fact that we don't think we're going to hit a deep recession in the near term, even a mild one where you'd see spreads widen out. You have enough carry that can make up for a couple hundred basis points of spread widening in high yield. That'd be a fairly meaningful correction over a 12-month period. Your carry would more than compensate you for that. So what the way we think about the next 12 to 24 months in credit is probably will be more of a bumpy road from an economic perspective. You've got geopolitical risk out there, still potential rate shocks. You probably don't want to be scraping the bottom of the barrel. That doesn't mean avoid high yield, but we think moving up in quality. So we like double Bs. We like triple Bs in the
Okay.
investment grade space too. We think, sort of splitting the middle, getting better carry, but not scraping the bottom of the barrel in terms of credit worthiness.
Interesting. You brought up downgrades in credit, and it seemed like coming out of the pandemic, and then all of a sudden we had the steepest interest rate hike in 40 years, and people are talking about worried about fallen angels, right? Was there, and I never really got the sense that that was a problem or really was impacted. Maybe, or maybe you just didn't see it enough. What's your thought on fallen angels, and really was it more of a we made too big of it?
Yeah, well, fallen angels, first of all, I mean, full disclosure, we have an ETF that invests in fallen angel
Okay.
bonds. So we follow them closely. We've had that ETF for over 12 years, managed here at VanEck. And so we follow the trends quite closely here. And the lack of new fallen angel volume simply reflects the length of the positive part of a credit cycle, sort of post-COVID. Certainly, first accommodative monetary policy and then fiscal stimulus have played a big role in these strong credit fundamentals. But that is why a lot of downgrades did not materialize, why a lot of defaults did not materialize among high yield and the loan markets. Maybe not, at least not as much as people might have anticipated when they saw rates starting to rise rapidly. We think looking out now, in that sort of 12 to 24-month view I was talking about, there is a good chance for fallen angel volumes to start rising again. Is regardless of where fundamentals stand today, refinancing costs or financing costs in general are rising. And so some of the weaker triple B credits are going to be exposed. You also have just idiosyncratic possibilities out there, like say a Boeing that's been seeing downgrades fairly consistently. You could call that some self-inflicted wounds if you'd like. But so we think the lack of fallen angel volume reflected general health in the credit space. Some of that government inspired, but certainly also responsible liability management on the part of U.S. corporations. By the way, as a fallen angel fund manager, we saw a lot of rising stars, bonds leaving our index due to being upgraded back to high yield, back to investment grade from high yield. And that's been a key driver of relative performance of, say, fallen angels versus simple broad high yield.
Interesting. It's considering all the concerns about the economy and rising interest, the impact. It's interesting that you had so many rising stars. You've brought up the Fed and monetary policies a lot during this conversation, and you got to talk about it given the topic is fixed income. So, given the recent FOMC announcement and the measures coming from the Bank of Japan and central bank policy decision making, where are the biggest areas of risk for fixed income investors?
Yeah, the I guess the beauty of normalization of rates, the way I'd like to try to define it is, you should think if we're in a fairly normalized period and we're unsure about policy, you should think about sort of relatively equal chances of rates, at least out the curve, moving higher or lower over the medium to long term. And I think the market was trained coming into this whole hiking period, just only think of in terms of when are rates coming back down. And I think we've learned that we're going to have to be more patient about that. Certainly from a policy perspective, but I think there's also a risk that the market doesn't recognize that 4%, 4.5%, where we might be at the time we're having this discussion on 10-year yields, still pretty low historically, actually. Yeah. We talked about ignoring that 2009 to 2021 period. Even including that, if you look at the last 50 years, 10-year yields averaged way over 6%. Of course, that includes the 1970s in early 80s where rates were high, but isolate a period like the 1990s and 10-year yields averaged closer to 6.6%. By the way, CPI averaged a little over 3% in the 1990s. That's another risk is that the Fed never really gets to its target on a sustained basis, at least. I mean, we can see prints at 2 or below 2 on inflation. So I think, curve's still inverted. Duration is a risk. So that's just something we keep reminding investors. It can be an opportunity in a big risk off environment, duration, but mainly it's a risk. It's sensitivity of the price of your bonds to movements in interest rates. And we think when you're moving, adding considerable duration to your portfolio, you're adding risk. And in US fixed income, that also means at the current shape of the curve, you're giving up yield at the same time you're adding risk. So we're still cautious about that move. We know certain investors can benefit from locking in yields for longer times, depending upon who their clients are. So there are various reasons to add duration at this point, but we're also quite cautious.
Interesting. Fran, that is fantastic. Thank you so much for coming on the show. It really is an honor. I learned a lot. We covered a lot of information there. Where can our audience get more information about VanEck?
Our website is definitely the best place,
Okay.
www.vaneck.com. There are, aside from just information about our funds, lots of insights from our product management and portfolio management teams, active and passive. And I understand we're kind of fun to follow on Twitter too. So, or X, pardon me, on
Yes,
X
we
as well.
better get that right, Fran.
Ryan,
Awesome.
thank you so much for having me, by the way.
No, it's a pleasure. It's my pleasure to have you on. Like I said, I've learned a lot. Really, it's an honor to have you on. And I read a lot leading up to this and preparing those articles I mentioned at the beginning. Your guys' website, you have a ton of content, very interesting content too. It was a good read throughout all of it. You, your team, and the broader VanEck team. So thank you. Thank you again, Fran. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our podcasts on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Thank you, and have a great rest of your week.